Well, the Dow Jones slumps after a two-day rally. This is a live look at the big board. Right now it's down 34 or really 35 points, but it was down as much as 300 points today. But joining us live right now is investment advisor Scott Reed, the CEO of Hardy Reid and the author of the Top 40 Rules of Investing. And of course, as you know, this has been a roller coaster year when it comes to the stock market. Right now we've entered a bear market, but what does it mean for your 401k as well as your IRA?
Well, I think the first thing you have to do is look and see if this is a normal market cycle or is there something different going on. And so we have roller coaster rides every year. We have an average of 14% down markets every single year, and then they come back and people don't notice. The difference this year is that the market started going down and it just kind of keeps trending down, right? And so in 2020 we had a 32% decline in the market, but it happened in between market statements, and so in February and March, and so it looked okay on your statement in February, it looked okay in March because it came back, and so nobody really noticed it. But this year it's been a grind, and the markets are certainly down, but it's pretty normal cycle stuff.
All right, so we shouldn't panic.
Well, there's almost no reason to panic if you own the market. If you own 3 stocks, you're not in the market, you're in 3 stocks, and they may do really well or really poorly no matter what the market does. You have to worry about those. If you're in the market as a whole, I mean, by the time you get to this point, we had 14 bear markets or market corrections since I've been in the business. The shortest one was 36 minutes, the longest one was a year and 4 months. So when people ask me how long this is going to last, I say somewhere between 36 minutes and a year and 4 months, and we're already 10 months into it, and now people are starting to worry. And by this time, usually the things you needed to worry about are past, and it's time to think about the future. And the future looks really bright in markets like this. After a bear market, after you hit bear market territory, which is a 20% decline, it's a quantitative thing. On average, the year after that, on average, since 1950, the market's been up 22% in the next year.
Okay.
It's been up 74% in the next 5 years. That's pretty good.
So how does one protect their investments?
Well, so protecting your investments is an interesting thing because our society puts short-term risk, associates short-term risk to long-term investment portfolios, and that's really not a very good thing to do. If you think about the next 20 years, the least risky investment out there is stocks. If you think about the next year, the riskiest investment is stocks. The problem is you have to go through 21-year periods of time to get to 20 years, and it's going to be a heck of a ride. And so I think you have to look at your time horizon. When do you need your money? If you need your money in the next year, it probably doesn't need to be primarily in stocks. If you need it in the next 2 to 5 years, it needs to be pretty conservative as people think about it, with a lot of bonds in it. Interest rates are going up. You're about to start getting higher percentage interest rates off your bonds. That's a good thing. It's not good to watch it go up because it's hurt the bond market this year, but once it gets there and levels off, that'll be good. And if you're in the long run, stocks are the place to be safe. It also happens to be the place that makes the most money. And so really time horizon is more important than what stock you own or what money manager you're using. But most of the people out there spend most of their time trying to figure out what stock to own, what money manager to buy. And that's really a really small percentage of what your actual return is going to be.
All right. Thank you so much, Scott Reed, for joining us this afternoon.